Hi, I'm Larry DeBoer, Professor of Agricultural Economics and Extension Specialist with Purdue University. I'm here at the Brown Street Levee in West Lafayette, Indiana, because this video is about levees. If this were a civil engineering video, we'd talk about the use of levees for flood control. But this is a video about property taxes. And in property tax terminology, the levy is the revenue that counties, cities and towns, school corporations, and other local governments intend to collect from the property tax. You can't drive your Chevy to the property tax levy, but you can drive it to a school or a library or a fire station that the levy supports. The property tax levy is the amount of revenue that local governments intend to collect from property taxpayers. It results from the local government budget process. First, the departments and agencies of a local government estimate their budget for the coming year. They calculate what will be needed for employee wages, salaries and benefits, for supplies, insurance, utilities, maintenance, and so forth, all the costs to deliver local government services. A budget is set for each of the local government's funds. Next, the government estimates miscellaneous revenue. That's the non-property tax revenue, like local government income taxes, motor vehicle excise taxes, state and federal aid, fines and fees, service charges, interest earnings, and so forth. Miscellaneous revenue is subtracted from budget estimates, and the result is the amount to be raised from the property tax levy. For most funds, that amount is checked against the maximum levy, which is a limit imposed by the state. The state's Department of Local Government Finance does the checking. This process means the property tax levy is different from other taxes. With the income or sales taxes, we start with the tax rate, and the revenue depends on how much income or sales are taxed. With the property tax, we start with the tax revenue, the levy, and set the rate to raise that amount from payments on taxable assessed value. The big property tax reform of 2008 was not the first attempt to limit the growth of property taxes. Back in 1973, at the start of the Otis Bowen administration, Indiana adopted a series of policies to reduce property taxes. The state sales tax was increased and the money was used to fund property tax credits. A local income tax was created to allow counties to cut property taxes some more. And a maximum levy was imposed to limit the increase of property taxes each year. The maximum levy cannot increase more than a certain percentage called the growth quotient. The growth quotient is calculated based on the growth of Indiana personal income. Personal income is the sum of the wages, salaries, rents, dividends, pensions, and other income received by Indiana residents. The state's Department of Local Government Finance, which oversees the property tax, calculates the growth quotient as the 6-year average of percentage changes in Indiana personal income. The same quotient is used for all units of government in Indiana. The idea is to make sure property taxes grow only as fast as the ability of Indiana residents to pay out of their incomes. Here's a chart showing personal income changes, the blue bars, and the growth quotient, the red line. In past years, the growth quotient usually has been between 3.5% and 5% per year, but lately it's been less than 3% per year. Since it takes a while for the federal government to report personal income numbers, they enter the growth quotient 6-year average only after 2 years. The recession cut Indiana income in 2009. That drop was included in the growth quotient average for 2011, and that's when the quotient dropped below 3%. That big negative year will stay in the calculation through 2016. Until then, the growth quotient probably will stay near 3% or less. The general fund and most operating levies are subject to the maximum levy. Debt service funds are not subject to the maximum levy. Local governments sometimes borrow in the bond market to pay for big construction projects, and debt service is money to repay those loans. Debt service is exempt from the maximum levy because bond buyers get nervous anytime there's a restriction on the ability of governments to pay back debt. If they see restrictions, like a maximum levy, they'll think local governments are riskier and charge them higher interest rates. So exempting debt service from the maximum levy keeps debt service interest rates lower. property tax levy is said to be bankable. That doesn't mean it's kept in a bank. It does mean that the growth quotient increases the maximum levy even if the local government has set its actual levy less than the maximum. From the 1970s through the early 2000s, the levy was bankable. For most of the 2000s, the levy was not bankable. If a local government set its levy less than the maximum, the growth quotient applied to the actual levy. This placed a tighter limit on property taxes, but it also provided an incentive for local governments to always set their levies right at the maximum. If they set it lower, they would collect less this year and permanently lose some of their ability to tax in all future years. Recently, the levy has been made bankable again. Here's a pie chart showing how the Indiana property tax levy divides up among units of government. School corporations collect by far the largest share, more than 40%, which is about as much as counties and cities and towns combined. When you add schools, counties, and cities and towns, you get more than 80% of the total. Townships, library districts, and other special districts levy the rest. The total levy is more than $6.5 billion before credits, the state tax cap credits, and the local credits funded by local income taxes. The levy after credits is closer to $6 billion. Up until the tax reforms of 2008, the school share was even bigger. School general fund levies were eliminated by those reforms and replaced by extra state aid. Until 2008, there was also a small property tax levy for the state government. That's gone now. These days, the property tax funds only local governments. Local government budgets are divided into funds. Funds are categories of spending devoted to different functions of government. Property taxes pay for a large part of most funds. The general fund is the biggest, with more than 1/3 of the total. The general fund pays for most of the operating costs of local governments, much of it employee pay. Debt service is next biggest, about 1/4 of the total. This is money for repayment of borrowed funds, usually for construction projects. The capital projects funds are 1/10 of the tax and are mostly for school equipment purchases and small construction projects. School transportation is for purchase and operation of school buses. Cumulative funds save for future construction and equipment purchases, and there are hundreds of other funds for all sorts of purposes. That's how the property tax levy is set. Once it's set, it's divided by the taxable assessed value to get the tax rate. Tax rates are applied to taxable property values, tax credits are subtracted, then tax bills are sent to property owners. And that money funds our local services. Thanks for watching. I'm Larry DeBoer.